Hitting your first $10,000 in savings is a massive achievement, but it leaves you operating with an incredible amount of systemic friction. At exactly 10 grand, your financial buffer is incredibly fragile. A single unexpected repair or medical bill knocks you right back into four-figure territory. Psychologically, that feels like resetting to zero. That lack of a buffer limits your options. If you're stuck in a toxic work environment, a small bank balance forces you to stay put. You simply don't have the runway to quit safely and look for better opportunities. Then there's the poor tax. The financial system actively penalizes low balances. In this diagram, we see how a $10,000 baseline is steadily chipped away. You get hit with $35 overdraft fees or a $12 monthly maintenance charge just for keeping your account open. You also miss out on economies of scale. You can't afford the upfront cost of buying groceries in bulk, and you end up paying your insurance bills monthly rather than securing an annual discount. $10,000 serves as a defensive shield against absolute catastrophe. But at $20,000, that constant friction lessens enough for your capital to begin contributing to your progress. This split-screen comparison highlights exactly how capital behaves differently at that higher tier. At a standard 8% annual return, $10,000 generates an $800 bar. But look at the $20,000 mark. The curve steepens, passively generating $1,600 a year. When we break that $1,600 bar down into 12 segments, you're looking at an extra $130 every single month. Your money is now generating enough to cover a utility bill without any extra effort. To understand the momentum this creates, look at this timeline. If you start from scratch and save $500 a month, it takes about 35 months to hit your first $20,000 milestone. Now watch what happens on the timeline below it. To save your second $20,000, it only takes 26 months. Your initial pool of money is generating its own returns, pushing you faster. Scale this up to $1 million portfolio, and the timeline compresses entirely. At that level, your money generates $20,000 in just 90 days. Moving past $20,000 means your money isn't just a static reserve anymore. The math clearly shows it has become an active contributor, shortening the timeline to your very next milestone. Crossing this threshold moves you into the investor class, where the focus shifts from merely accumulating a base to allocating assets effectively. These two pie charts show why those choices are dangerous at lower levels. If your entire net worth is $10,000, maxing out a $7,000 Roth IRA removes a massive 70% wedge of your liquidity. But at $20,000, you can absorb that exact same wedge while leaving the majority of your cash accessible. With the risks spread out, you can properly categorize your capital into a multi-tier structure. You can lock up $7,000 in a retirement account, keep an $8,000 emergency fund, put $3,000 in a taxable brokerage, and still leave $2,000 in checking for daily life. Having a dedicated emergency fund means your investments are truly separate from your living expenses. When the stock market dips 20%, you simply do not have to panic sell your shares to make rent. Separating capital into these specific protective and defensive categories changes how you experience financial volatility. You have earned the ability to wait. Financial independence exists on a spectrum. Reaching $20,000 buys you between 6 and 10 months of pure runway. It buys you options. Escaping survival mode pushes you up Maslow's hierarchy of needs. You stop operating out of physiological panic regarding your next meal or rent check, and you begin to optimize your life around safety and personal freedom. Building that initial runway requires an intense mastery of delayed gratification. In the 1970s, the famous Stanford marshmallow test offered children one treat immediately, or two if they could wait 15 minutes. The researchers tracked those children for decades. The ones who demonstrated extreme self-restraint performed better academically and built massive careers later in life, including the late CEO of YouTube, Susan Wojcicki. Hitting your savings target proves you have that exact same self-control. You adopt the identity of someone who is highly capable with capital, and that belief translates into a continuous cycle of better financial decisions. To reach this tier quickly, you have to establish a strict financial baseline. You need to gather every scattered data point about your net worth, your income, and your monthly expenses, and snap them into a highly organized picture of exactly where your money goes. Next, you play defense. Track your spending for 30 days to identify the hidden leaks in your budget. It's incredibly common to review a month of statements and realize you're burning $800 a month on ride-sharing apps without even noticing. Finally, you play offense. Accelerating your savings rate requires aggressive inputs. Research the salary data for your role and negotiate a 5 to 10% raise, or dedicate your weekends to a side hustle. The initial grind to $20,000 is often the most demanding part of the journey. Finishing this phase builds the consistency and financial momentum necessary to reach total independence.